Hi friends, welcome to Stocks Daily, the channel where we let the billionaires work for us. In this episode, I'm going to cover Cirrus Logic, ticker symbol CRUS. I really believe the stock has a 2x or even a 3x potential, and I'm going to highlight the growth opportunities, the valuation and the risks worth considering, so stay tuned. So the company's share price recently dropped due to the earnings release, but I strongly view this reaction as being unwarranted, and I truly see a bright future ahead for this company. The markets didn't take kindly to the latest company quarterly results, and the share price dropped 12% since the earnings, which came out in February the 1st. To be honest, this is a massive overreaction because the company demonstrated strong operating results and remains highly profitable. However, I'm not complaining because the stock surged about 28% in January, and this latest short-term drop is a fantastic buy the dip opportunity for long-term investors with a lot of upside. So first, let's go over the good stuff and then we'll cover the bad and the finances. Cirrus Logic specializes in audio, voice and haptic technology primarily for mobile phones and other consumer tech devices. The company has actually been around since 1984 and they got a lot of experience with smart codecs, audio amplifiers, haptic drivers, sensing solutions and camera controllers. So they're pretty diverse. They were also the leading supplier of audio in smartphones in 2020 with over $1.3 billion in revenue, and one of the things that make them a global leader in the market is their technology behind the ultra low power usage of their chips. Obviously, the less energy these chips need, the more battery power you have for your phone or your iWatch or your laptop, and the longer they stay alive. And to stay ahead of the game, chips can't be demanding power. So they have to be ultra low power demanding. Cirrus Logic continued to execute well in 2020 despite the whole Roni situation, with revenue increasing by a fantastic 30% year over year in Q3. A lot of this revenue growth was driven by the iPhone 12 launch in October last year, because the iPhones are currently using 4 Cirrus Logic chips. And we all know these silly iPhones are doing insanely well. Myself, I'm an Android guy, so I don't highly rate iPhones, but Apple is a lifestyle company, and when they get you in, they keep you in.
Just when I thought I was out, they pulled me back in.
Gross margins are down slightly by 90 basis points, so less than 1%, from a whopping 52.7% in Q3 2020 to 51.8% in the latest quarter. I'm not too concerned because although the margins are already fantastic, and management accepts margins to improve from April through to 2022 because of improvements to supply chain efficiencies and favorable product mixes. Audio is the bread and butter of the business, but the thing that makes me really bullish is the management's focus on 3 specific areas of growth. So they're diversifying. Of course, you have the market share in smartphones and expanding share in audio beyond smartphones like laptops and watches, but also increasing audio content. But thirdly, and most importantly for me, the new high-performance mixed signal solutions beyond audio. I see this signal solution segment of the business being a massive growth driver for the company in the future, and it's basically a natural evolution of their technology offerings beyond audio. The mixed signal segment of the business is having accelerated revenue growth, and in 2021, management forecasts 19% revenue growth for that segment, compared to 12% and 13% in 2019 and 2020 respectively. So it's definitely a growing part of the business. Check out this chart from the company's February 2021 investor presentation that just came out. The total addressable market for this segment of the business is expected to grow 50%, from 30 billion in 2019 to 45 billion in 2024. That's not Tesla level growth, but it is fantastic. And being the industry leader that it is, I think the company can capitalize on the growth and execute with great margins. During the QA section of the February 2021 conference call, the management were really optimistic on their opportunities in the near term regarding their custom products for Apple and iPhone. They said that the opportunity with Apple is sufficiently significant and meaningful that they're very upbeat about the future based on that specifically. Personally, I think it's a bit risky to have 80% of your revenue coming from one customer. I mean, look at what happened with Intel stock when Apple announced their M1 chip. It tanked straight away, 10% in one day, just from that alone. And obviously Intel's doesn't have 80% of their revenue coming from just Apple alone. So it's a slightly more diversified company. So if God forbid, Apple announced their own audio chips, Cirrus Logic would get destroyed. But like I said, they're custom chips, so they work very closely with Apple, and likely they have a very good relationship. And Apple so far hasn't fully vertically integrated. They don't even make their own phones. So I can't see them not using third-party manufacturers at all, at least in the near term. And the chips that the company make for Apple, like I mentioned, are custom chips. So they're working closely with Apple to make these chips specifically for Apple and iPhones. And there's a lot of technology transfer going on both sides, and they can both benefit from that. And on top of that, I'm sure the contract between the two companies is secure enough, which makes obviously Cirrus Logic, his management team, very confident. Meanwhile, the business maintains a very strong balance sheet, very little long-term debt, 327 million in cash as of the trailing 12 months, and over 1.2 billion in short-term investments. And don't forget, this company only has a $5.2 billion market cap, so their balance sheet is maybe one of the best I've ever looked at. This high level of financial flexibility allows the company to repurchase its shares, and it has been doing so, with the company's share count outstanding being reduced by nearly 9% in the past 5 years. Personally, I'm not a massive fan of share buyback because I think those funds would be put to better use in R&D, and I guess it is a bit short-sighted to be doing share buybacks. But revenue growth and reduced outstanding shares means much higher EPS. And that will certainly drive the stock price up and generate more hype around the company, squeezing the stock price higher, and down the line the company can reissue those stocks at a massive profit. So it's good to see that the company is betting on themselves. And looking at the company's balance sheet, I think the company is very well positioned for mergers and acquisitions due to its strong balance sheet and other benefits of share buybacks. And another benefit of share buybacks are that if a good merger and acquisition opportunity arises, the company can offer shares instead of cash to purchase emerging companies with technologies that would benefit the company's offerings. And the company is diversifying and developing its technologies, so it's not like they're doing no R&D. So if you're doing R&D, you're investing in yourself, and you're doing share buyback, then that's all right, in my opinion. But if you're not doing any development, you're not doing any innovation, and you're focused on share buybacks like a lot of these banks are, I think that's very short-sighted, and in the long term, that might hurt their moat. The main major risk I see with the company from a macro standpoint is the fact that the company is so closely tied to the smartphone market. Obviously, this has worked well for them with revenues and growth margins looking fantastic, but it's risky, especially when you consider its ridiculous reliance on Apple. Apple making up 80% of its revenue. In my opinion, the company's stock will likely mirror the success of the smartphone releases. However, as they're branching out and they're diversifying, and it seems like they're very interested in doing that, this might mitigate any risk associated with the smartphone market. Alright, so looking at the company's valuation, I see the company to be quite attractive around the $86 mark with a forward PE of 18.7, which, come on, let's face it, for a tech company that is super low, especially nowadays. For the type of companies that I look at, it is super low. EPS is projected to grow at mid to high single digits in 2020 through to 2024, and given what I see with Cirrus Logic's strong moat and positive future growth, I would expect it to trade at a forward PE of 25, if not more. Wall Street currently has a buy rating on the stock, with most analysts recommending between a hold or a strong buy. And the average price target is $103, implying a 20% upside from the current price. So to sum up, the company has a great business that has demonstrated continued growth in the past year, and the company has a bright future due to the initiatives to take market share in the fast-growing mixed signal business. The company has a fantastic balance sheet, which gives the company room to explore mergers if the opportunity pops up, and they're in a position to pump the stock through share buybacks. I think the company is attractively priced after its pullback from $100 a share, and this dip is a fantastic buying opportunity to get involved, and I really think the market's overreacted to the earnings report. I can really see this company 2.5xing to around $200 a share by 2024, so there's a lot of upside for a long-term investor. That's all for today. Please leave in the comments if you own the company or if you're planning to buy shares in the company. And as always, thanks for watching. If you like the content, please leave a like and consider subscribing if you want to see more. You've been awesome. Thanks.